All right, so hello everybody. My name is Chris Bushnell with Movement Bank, and I am joined by the one and only Evona Cholewa of the Caldwell Banker and Key to Charlotte.
Thank you.
And man, we are so excited to be here today. I'm so excited to speak with you, Evona. We're going to be talking about how much does it cost to buy a house, and man, Evona is got to be one of the best people to hear this information from. She has helped so many people obtain home ownership here in Charlotte. One of the top realtors in the entire city. She's humble, so she won't tell you all these things herself. But she's just made a huge impact here in Charlotte, North Carolina. It's helped so many people. And I don't want to take away your spotlight, Evona. Can you tell people who you are?
Evona Cholewa with Caldwell Banker and Key to Charlotte. It's a company in a company itself. I had numbers of businesses prior real estate, but real estate is really always was on my back of my mind to do that. So I'm happy I have finally decided to do it many years ago. I joined the forces first with Remax Executive and then moved to Caldwell Banker. So many transactions later, here I am, helping Charlotte to move from one house to another, and I hope I can answer some questions today.
That is awesome. Thank you so much. I'm so excited to have you here, Evona.
Thank you.
So let's talk about it. So, buying a house, there's, and how much does it cost? There's so many different ways we could talk about this, right? We could talk about, of course, monthly payments. We'll talk about interest rates. We'll get into that. But then there's all these other things, right? What are closing costs? How much does what are the different costs? We're talking about taxes, we're dealing with insurance companies, we're dealing with attorneys' offices, realtors have to be paid too, right?
Right.
We all got families to feed.
Right.
So let's talk about that. That's a question that my clients will ask me often is, how much does it cost me to use a real estate agent to buy a house?
Correct. So as a buyer, this is interesting, we have to properly separate this from the seller point of view and the buyer. Traditionally, in the United States, the seller pays the buyer's agent and the selling agent, which is the listing agent. And the way it works, it's divided. Whatever the listing agent negotiate with the seller, it's put it in MLS, and then we know this upfront how much that's gonna be, but it is gonna be paid by the seller at the time of the closing. Some companies may add to it transaction fees, and different companies use different. It could be anything from $100 to $500. So something to keep in mind at the closing. That could show up, and that would be conversation to have with the buyer's agent. But traditionally, to use buyer's agent, it does not cost buyer almost nothing.
Really?
Almost nothing. Yes, it is. So
it's
it's kind of a free advice, I would say. I say it as a free advice, but not to use an agent, especially when you buy a agent, it's almost a crime because we do so much behind the door. People do not even realize. Strongly recommended to do it. Mm-hmm.
So the sellers are typically the people who pay the buyer's agent.
Correct. Seller is the one who pays buyer's agent and the listing agent. And all this is done and only done after closing. So this is another thing. Some people I know, they use some kind of a retention fees up front. Very few agents do that. It's usually they do get paid after closing. So there's no closing, it's just too bad.
That's awesome. It makes me think, right, if the buyer doesn't actually pay their buyer's agent, for me it's like I've always, I want the best, right? I want the best service, I want the best experience. So you're basically saying that if I'm buying a house, it doesn't cost me anything different between using the best realtor versus maybe somebody else.
Correct. This is absolutely right. The only thing I want to talk about it, if you work with the buyers or you are buyers and you find a house for sale by owner, there could be some instances that the owner of the house, the seller for sale by owner, it will not cooperate with the buyers or the buyer's agents, and will ask them. We will be asking the buyers to some kind of a fees, and that's something has to be agreed upon prior buying that house.
Gotcha. So if the sellers are sort of acting as their own realtor in the sense,
correct,
then the buyer may have to pay. That
So
makes
this
sense.
this is the only situation. But a lot of even for sale by owners, what we
Mhm.
call FISBOs, they do actually work with the agents, and the reason is mostly because they don't really know how to sell it.
Yeah.
I don't know why they have no idea about the paperwork and everything. So
Sure.
some of them will be, yeah, sure, I work with the buyer's agent, so that would be also something. But yes, to the point, if they use the best one or just anybody, actually it's the same. So
Wow.
it's really just the research you do it, who you're gonna be hired, and that makes a huge difference. Even how much a house can cost or what can be done, negotiation and everything in between. It's a long process to buy a house, but that's definitely, like you said, it makes no difference.
Yeah.
It makes no difference, but
Okay.
on the end to the buyers, it's gonna make a huge difference. What kind of a house you're gonna buy
Mm.
and for how much.
That's awesome. Yeah, I can speak. When I bought a house a few years ago, I can tell you exactly what I did because I sort of knew that too. I knew that the sellers are typically the ones who pay my buyer's agent. So I'm thinking, oh, I'm going to use the best buyer agent that I can find.
Right.
And I just went on Zillow and I saw, okay, who does the most transactions,
Right.
and that's kind of tells me if they're good or not. If they're
Not
good.
really.
Oh,
I
okay.
really want to tell you, it's a kind of stuck with that. The reason is not everybody, so you have to understand Zillow.
Yeah.
You brought a great point.
Okay.
You have to understand Zillow, which is, I know it's like a platform, everybody is looking on Zillow to find everything.
Mm-hmm.
In order to be highest ranked agent on Zillow, you have to pay Zillow.
Really?
Yes.
Wow.
So that's a lot of people do not know that.
Okay.
So if you're not part of Zillow, I would
Mhm.
say, your houses, even if you have listings or buys, are not gonna show there.
No
So
way.
it's not
I
gonna
didn't even
show.
know that.
This is great point you're
Yeah.
bringing because a lot of people do not really know that. A lot of
Yeah.
people do not understand how Zillow works, and they go and they Google and Zillow show up and
Yeah.
oh God, you said 5 months, 5 houses and they sold 500 houses. That's not how it is. Zillow started, you had to pay in to get the Zillow leads,
Mhm.
but then you're higher ranked in a Zillow platform.
Interesting.
Yes,
Okay.
yes. So that's not something, it's not 100% accurate, I would say. It's
Okay.
just because somebody's not on Zillow doesn't mean it's a bad agent or anything like
Okay.
that.
So if I
I'm
am
on Zillow, but it's just,
so if I am buying a house and I want to work with the best realtor,
Mhm.
how do I find the best realtor?
I would truly interview people.
Okay.
I would truly interview realtors because it could be not it with the it's like communicate with the people, not all. Sometimes personalities doesn't click. Sometimes we have different. I would find somebody who is looking in the who is selling in that area, who understands the area. It's hard to be. It's easier to list the houses everywhere. It's harder to buy. You really have to understand the city. Each street is different. Sometimes neighborhood are divided into states, and we have plenty of those neighborhoods
Yeah.
which divided into states.
Yeah, right here
Or
in Charlotte.
divided, yes, or divided into different schools, and you really have to understand the area. I think those are the best agents for you who actually work in particular area than anything else. Who knows the streets, who knows, and can find you the house which is the best for you, for your family.
Yeah.
So that's I would think interviewing.
So interview maybe like two or three.
at least. You're always gonna have somebody who is gonna recommend it. They're great, and that's fine. But I would just kind of interview somebody else as well. I think it's a good and ask for portfolio, show them for some kind of achievements. What kind of achievements people have? What kind of rewards they got?
Yeah.
What kind of, so that's all tells you how many transactions they had. Everybody can show that,
Mm-hmm.
so you can verify all this information.
That's great information.
Mhm.
So now we know the buyer doesn't pay the realtor. What other questions in regards to, how much do I need to pay for a house? What are some questions that you hear from people?
How much money do you need to buy a house? And that would be a question for you, I think,
Yeah.
more than anything, because we're going into the rates and down payments and all this. But yes, this is definitely a question, especially for first-time home buyers who don't. The myth, I think, the word on the streets is you need 20%.
Mm-hmm.
And I hear that sometimes a lot, even from my sister, which I was shocked when talking about.
Yeah.
Where did you get this from? No, we don't, and I know that we don't need 20%. Can you tell us maybe
Yeah.
how much do we need is actually savings in down payments and other fees? I mean, I can talk about closing costs on the end of whatever you have to tell us, but how much down payment do we need? how much?
Yeah, great question. So the question is, how much of a down payment do I need to make?
Mm-hmm.
Great question. So, the first thing, maybe the most important thing, like you had mentioned, it's not 20%, right? We're not living in 1980 anymore. We're not required to put down a 20% down payment. In fact, there's a lot of 0% down payment programs, so that's no down payment.
Right.
Most down payment programs start at between 3 and 5% of the cost of the house.
Mm-hmm.
I'd say maybe the average down payment is around maybe 5 to maybe 10%. And then 20% is really the most that anyone would ever pay.
Okay.
But most people are putting somewhere between 3.5% to 5% of the cost of the house.
Correct. But with that, there's gonna be association fee. If you put less than 20%, that's my understanding
Mhm.
of this was what is called PMI.
Yeah,
that is
PMI.
the insurance on the mortgage, right?
Mm-hmm.
This can only go away when you have 20% equity. How does it work?
Close, right? So the first thing, PMI, right? And a lot of people have heard of PMI, and it has this sort of stigma behind it.
Mm-hmm.
And you can look at PMI there's two perspectives that you can look at it.
Mm-hmm.
You can look at it like an extra fee that you have to pay if you don't put down 20%, or you can look at it the way that I look at it, which is a tool that helps me buy a house without putting down 20% down payment. So PMI is a monthly cost that we will have as long as we have a conventional loan where the balance of the mortgage is more than 80% of the value of the home.
Okay.
Right, so when I say conventional, if we have an FHA program, we are going to have PMI for typically the life of the loan. Now, if you put down larger down payments, you may be able to get rid of the PMI, but most of the time, 90% of the time, if you have an FHA loan, you're going to have PMI until you refinance to a conventional loan. One thing that I see is very, very popular right now is that people get FHA loans, and after a few years, they will refinance to a conventional loan.
Okay.
But to your point, let's talk about specifically conventional loans, because with conventional loans, you'll have PMI when the balance of your mortgage is more than 80% of the cost of the value of your home.
And what would be the cost? What is that cost of the mortgage insurance? Because
Mhm.
what kind of a money we're talking about?
Sure.
So we're trying to figure out, is it worth it to make sense to put less or not? Like what kind of cost it is?
That's a fantastic question. And the answer is it depends.
Oh, okay.
So with FHA loans, it's always the same thing. It's always 0.55% of the loan amount.
And this is for FHA only?
For FHA only.
Okay.
It's always the same. So it doesn't matter what your credit score is, it doesn't matter what your down payment is, it doesn't matter what kind of house it is, it's always 0.55%.
Okay.
So for every what is it, $100,000 of a house, that is 0.55%, that's $550 annually.
Annually.
Divided by 12, right? To get the
Wow, so
month.
it's not really that much.
It's really not that much at all.
Okay, but with conventional.
With conventional, it's different. So with conventional, there's a lot of different factors that go into it. It depends on your credit score. It depends on what your actual down payment amount is. It depends on the type of property. It depends on if you're gonna live in the property, like the use of the property. Are you living in it? Is it an investment property? Is it a second home? There's a lot of factors that go into it.
Okay.
And with conventional loans, it ranges from 0.1% of the loan amount all the way to 2% of the loan amount. So think of it like this, if you're kind of in a not so great situation, 2% of the loan amount, so for every $100,000, that's $2,000 per year divided by 12, which is why for a lot of people, if depending on what your PMI is, just go FHA. Right? And that's why it's really important when we're talking about the cost of doing the loan. What people need to understand is that there's never just one loan, right? We always have the option of going conventional or going FHA or other programs. There's so many programs out there, and all of them are going to have their own costs. We're sort of being general here, but the point is, work with a great mortgage professional who's going to put these options on paper for you, and explain them, and then see the numbers yourself and say, okay, this one aligns with my goals right now.
Right.
And the PMI, which again I'm a fan of, because I would rather pay 3% and pay a little bit more monthly. Then if I want to buy a $300,000 or $400,000 house, okay, it's easier for me to come up with $12,000, which is a 3% down payment, than $80,000, which is a 20% down payment.
Right.
Give me the PMI so I can buy the house and gain equity, right?
And this is what we have to talk about, because a lot of people say, I don't want to pay that, I'd rather wait and save this 20% not to pay that, and which does not make sense, right?
Yeah.
Even from a mortgage standpoint or our point.
It
or
doesn't
rental
make
point,
sense.
it
20%
does not
is
make sense.
overrated and it's a myth.
Okay, so
Yeah.
it's a myth. My sister believed in maybe
Yeah.
that I am a realtor, but when she
Yeah.
told me that, I'm like, where have you been? I don't even know anybody who put 20%, unless it's a third house or
Sure.
something, it's a different story. But buying a first house, almost, I've not seen anybody who does that.
Exactly. There's really, you don't have to, and there's almost no benefit in doing it. Even if I had the 20%, I would rather save it for, if there's repairs, maybe I want to buy furniture, definitely better putting that stuff on credit, right? Or maybe I want to invest it somewhere else.
Correct.
The money is probably, and definitely speak with a financial advisor, if you have this amount of money and you want to know where to put it. But I would rather still put down the minimum and use my money elsewhere if I have it.
Correct. So buying the house, we're gonna go to closet, how much money do we need? So we know we're gonna need some kind of a payment. It could be from 0 to 20%.
Yeah.
But it's usually now. What other cost association with the lending money would the buyer can expect?
Sure. One last thing I want to touch on right before we go, when we're talking about PMI. With conventional, when we say we have PMI when the balance of our mortgage is more than 80% of the value of our home, let's remember, especially if we're living here in Charlotte, you can expect your home to appreciate at least 5% per year.
That's true.
Right? That's pretty conservative,
I agree.
right?
Yes, it is.
That's
It's
super
anything,
conservative.
When I point, I notice, and depends on neighborhood, it's anything from 5 to 10%. You can see it, and that's statistically, we're looking at statistics.
Every 12 months.
Uh-huh.
So if I buy a house, a $400,000 house, I make a 3% down payment, so that's $12,000, meaning I have now a $388,000 loan.
Right.
Right, and then that $400,000 home appreciates by 5% per year.
Correct.
So in 1 year, that's $420,000. So remember, it's when the balance of the mortgage is more than 80% of the value of the home. As the value of the home goes up, and we just naturally pay our mortgage because we're just paying it down every month, we're only going to have PMI for a few years.
That's true.
Especially at that appreciation level.
Correct. And then it goes down, is the lender who will take it down, or the buyer, the owner has to call the lender, can we reevaluate the house, can we do the appraisal again? So how is that initiated, by the owner of the house or by the lender?
That's a great question. Typically, the homeowner should be proactive and reach out to the lender.
That's what I tell my people too. I usually check it once in a while. I will say, maybe you should check. So that is true. It should be the owner who does it.
The lender won't take into account the appreciation of the house because they're not really tracking that stuff.
Right.
But if you can show property tax records, or you can do an appraisal on the home to show that it has gone up in value, it's the easiest way to get rid of the PMI.
Correct.
I'll spend $600 on an appraisal to no longer have to pay this monthly payment.
Correct, and be just done with it. Okay, so we covered the PMI. What are the costs
Closing
with
costs.
the lending?
Yeah.
Money? Because there is, closing. I think closing costs is a lot. It's a broad. There's a lot in closing costs.
Super.
Which is separate. Which are like the attorney's fees are very separate. There is taxes. There is items, but there's all this closing costs associated with the lending of the money.
Sure.
What else is there?
Sure. So what does a home buyer pay the lender? Is your question?
That would be question. Yes.
Okay. So I want to answer that question by maybe first explaining what a home buyer does not pay a lender.
Okay.
All right. And that is commissions to the loan officer. Right. A lot of people think that depending on the bank that they use or the loan officer that they use, that that just like with a realtor, they think that they have to pay their loan officer. Home buyers don't pay loan officers. Loan officers or mortgage advisors like myself, we get paid by the bank that gives the client a mortgage.
Oh.
And it doesn't matter on what their interest rates are, it doesn't matter what kind of fees or closing costs they pay.
That does not depend. This is how much you're going to be paid.
None of that matters for a loan officer.
Okay, that's interesting. Okay,
Yeah.
I'm learning.
A loan officer gets paid by the bank that gives the client a mortgage. And the loan officer gets a commission based off what the loan amount is.
I see.
It has nothing to do with interest rates or fees or anything like that.
I see.
So that's what the home buyer does not pay. What they do pay is typically 99% of banks are going to have some type of origination costs.
Okay.
Or just basically that's just the cost of doing the loan. So what a lot of people don't realize, there's a lot of people who work on providing someone a mortgage, right? There's between 15 and 25 people who will touch a mortgage application.
Are you serious?
Yeah, before the bank gives out the loan.
Wow.
A
So
ton
it's
of
just
people.
it's not just you and somebody behind who
Yeah.
is the what they call
Like a
it?
processor.
Processors, yeah.
Yeah.
So there's more. than
Yes.
that. Oh my goodness. Okay.
The home buyer will usually only see or speak with one or two people.
Right.
Typically, they'll always speak with their loan officer.
Right.
Maybe they'll speak with their processor.
Correct.
But that's it, right? However, there's a ton of things that are going on behind the scenes to fund that loan.
Interesting.
And that's why you're going to see basically all banks. Maybe there's a couple that don't have this, but the vast majority have some type of origination fee. It's usually between $1,200 and $1,600, and it's a fee that banks charge to do the loan.
I see. Okay, that's very interesting. So this is origination fees. What other fees that could be?
Sure. One fee that there could be or there could not be, it really depends. It's something called discount points.
Right. Explain discount points.
Great. So what are discount points? And this is a
What is
question I get asked this all
Yes.
the time.
Yes.
Discount points are essentially prepaid interest.
Prepaid interest. Okay, upfront. Okay.
So if I'm buying a house, I can technically get any interest rate that I want
If you pay upfront.
if I pay discount points to get it.
Okay.
So discount points are, remember, it's prepaid interest. So if I wanted a rate that's, a lot less than what I'm being offered, I can pay prepaid interest, known as discount points,
Right.
to get the lower interest rate.
Okay.
Sometimes, depending on different factors such as the real estate market, maybe the type of house, I may be mandated to invest in discount points.
Okay.
So, for example, and I'm not sure when people are going to see this video,
Right.
but in 2022 and the beginning of 2023, where we're in a higher interest rate environment, right?
Right.
Interest rates are higher than what most people want them to be, with the expectation that interest rates should probably fall within the next couple of years.
Right.
So because of that, because interest rates are higher now and they think that they're going to go lower later, some people may have to pay discount points whether they want to or not.
Oh, okay.
And that's because the bank who's giving them the mortgage knows that they're going to refinance as soon as they get a chance.
I see. Okay.
Right.
They're not gonna lose their money. Okay.
These big banks, right? These
Right.
mortgage companies, they get paid off of interest that
Yes,
people
they
pay
do.
monthly.
Right.
But if they give out this $400,000 loan, person pays interest for 12 months and then refinances and goes to a different bank, that bank didn't make any money.
Okay.
So they're going to charge you a little bit up front so that they can get paid.
And what would that be? What kind of amount are we talking about?
It
What
depends.
percent?
It depends. It depends on the risk profile of the transaction.
Oh, I see.
So
Okay.
here's what I mean by that. Typically, if you're buying the house that you're going to live in,
Mm-hmm.
and you have average to above average credit, you're probably not going to be required to invest in discount points
I see.
because it's less risky for a bank to give someone who's going to live in a house a loan versus an investor. Here's why. If you're buying a house in a high interest rate environment and you're an investor, you're gonna have to pay discount points.
I see.
And again, this depends on the market.
Right.
We're just talking about a higher interest rate market, and that's because if I'm someone and I have two houses, I have a house that I live in with a mortgage, and I have a house that's a rental property with a mortgage, and the tenant moves out, and I can only pay one of those mortgages.
Right.
Which one am I going to pay?
I see.
I'm going to pay the one that I live in
Correct.
because I want to keep that house because I live in it with my family. So investment properties inherently just have a little bit more risk than a house that you live in, so they may have discount points.
I see.
To specifically answer your question about how much do they cost, typically it's based on the loan amount.
I see.
So one discount point equals 1% of the loan amount.
Okay, so we're talking about some sum.
Correct. But what one discount point does not equal is it does not equal an interest rate. So for example, if you invest in one discount point, that does not mean that your interest rate is going to go down 1%.
From 6 to 5.
Correct.
This is not what it
One
is.
discount point will not take you from 6 to 5.
I see.
And it's really, to answer that question, like, okay, how much does a discount point, how much does it get me? It depends. Different times have different, it's all based on factors.
Okay, so there's no set. amount.
There's no set amount to where one discount point buys my rate down X amount of dollars. That is not a thing.
Okay.
It's just the cost of the discount point.
So I think people get mixed up with discount points and with the buying down the rate.
It's the same thing.
It's the same thing. So it is the same. So is it? What would you say? Sometimes you have to buy it. Sometimes you have to do it. But in general, is it make sense to do it or not? Or you would just kind of go with this, marry the house, take the rate, and then when it comes down, it's just finance kind of a thing?
Sure. And so the
If you don't have to buy.
the question is, if you don't have to buy discount points, should you invest
Right.
discount points? It depends.
Of course.
So here's what it depends on. It depends on how long you expect to have that mortgage.
Right.
So in a normal rate environment, when things are not too high or too low, the average first-time home buyer keeps their mortgage for 3 to 5 years.
That's all.
That's it.
Okay.
So it doesn't matter if it's a 30-year mortgage, a 15-year
But they
mortgage.
don't move that often.
Maybe they do, maybe they don't. So one of two things happens.
Statistically, they don't lately.
Well, statistically they don't
So
lately
they're
because everyone who bought a house in 2019, 2020, 2021 have an interest rate that's extremely low, and they don't want to sell that house because they have a really low interest rate here, and it would cost them a lot more money to get another house at a higher interest rate.
Right.
So that's why currently we're not seeing that. But if you're buying a house in 2022, 2023, where your interest rate isn't below 3%, right? Or it's not super low. It's probably in the 5s or the 6s, right? The average home buyer, first-time home buyer, has that mortgage for 3 to 5 years. So they could maybe sell the house, or they could just refinance.
Right.
In this case, they're probably more likely to refinance, right?
Right.
Anyone, if someone has a 6% interest rate and it could go down to a 4, any logical person would refinance.
Correct, yeah.
Right.
Makes sense.
So to answer your question, are discount points worth it? Here's what I would do. Is I would put the numbers on paper, and I would say, let's look at option number 1. Option number 1 is I'm not investing in discount points. Here's how much money I need to bring to closing. Here's my total closing cost plus down payment. Here's my monthly payment. I would look at option number 2, and option number 2 would be, what if I invested in discount points? If I invested in discount points, I'm gonna pay more up front, but I'm gonna have a lower monthly payment.
Right.
And here's exactly what I would do. I would subtract the lower monthly payment from the higher monthly payment.
Okay, and see the difference? Okay.
See the difference. So how much would my monthly payment go down if I invest in the discount points versus not?
Correct.
All right, so we got that part. And then what I would do is I would subtract the lower closing costs, right? So I would subtract the amount of money I'd have to pay by not investing in discount points versus from the amount of money that I would have to pay if I did invest in discount points.
Okay.
So basically I'm saying, how much money do I have to pay to drop my monthly payment by X amount?
That's a good approach.
Right,
Not
so
everybody does this. Okay.
This is the
Very
best way to do
logical.
it.
I like this.
If it costs me $2,000 to drop my my mortgage payment by, we'll call it $50 a month, right? And there's very likely that I will not have that mortgage for more than 5 years.
Is that making sense?
All right. What I would do, $2,000 to invest in discount points, it saves me $50 a month. I'm expected to have that mortgage for 5 years, which is 60 months.
Right. That's fine.
I don't have my calculator here. Oh, I do. So,
I'm not
if I divide 2,000 by 50, that equals 40.
Right.
Right? But it's going to take me, and I'm likely going to have my house for 60 months.
Right.
All right, 5 years equals 60 months. So if that's the case, it probably is worth it to invest in a discount point. Because if I have the mortgage for any more than 40 months, I will have gotten a return on my investment.
Right.
But let's say that I invested $2,000 and it decreased my monthly payment by $20 a month. That means it would take 100 months to get a return on my investment. And in that case, it's not worth it. Because I'm probably only going to have that mortgage for 60 months.
It makes sense. I like.
Right?
I like the way you presented that. So we have the origination fee. Depends if you're buying down the rate or closing or discount points. Either way, it's the same thing. You need down payment. What else is going to be from the lending stand? Is there any other fees on the lending part?
That's it.
That's it.
That's it from the lending part.
So on the top of whatever that would be, then you have to add the taxes you pay on a house, HOA if there's HOA, attorney fee, wiring fee, and
insurance, appraisal.
Insurance appraisal. Appraisal is about what, $500-$600?
Yeah, basically.
Is it paid up front or is it paid at the closing cost?
It's paid up front.
Up front, like home inspections, usually.
Correct.
Okay, so that will be paid, but you have to put this money aside to pay.
Yes.
So generally, to buy a house, what percentage you would say you have to have? You buy a house for 200. How much money you have to have?
You can expect.
What's the expectation?
Closing costs with everything, including the lender fees, attorney fees, insurance, taxes, appraisal, everything.
And the down payment.
And the down payment. You're typically looking at between 2.5% to 3% for your closing costs.
I see.
And then the average down payment is between 3 to 5%. So the most that anyone would pay as a first-time home buyer is 8.5%, but it could be a lot less.
Okay.
With closing costs.
So closing cost is 3%.
Approximately. Yeah.
And on the top of it, it would be down payment. On the top of it,
Plus your down payment. You have your down payment and your closing costs.
I see. So we're talking about 8% kind of. And we separate.
Probably at the most.
So we're gonna separate into the lending fee, attorney fee, and buying of the house, like taxes and all this, wiring, the process of buying the house, the lending fees, and the down payment. So there are 3 components to it. Is that,
you have your lending fee, your attorneys, taxes, insurance, appraisal. There's always gonna be third-party fees.
Yeah.
If we're buying a condo, there's condo fees.
Condo fees, and
That's a whole nother.
That's another.
episode.
HOAs and
HOAs.
I think that would be great actually to do about HOA and stories of HOAs.
Oh, but yeah, we can go on for days.
That's true. That's true. So.
But yeah, I think that the best way that I would recommend going about it is just lump sum it all together. My closing costs are about 3%.
Okay.
And sure, it's gonna go in all different areas, but you're gonna have to pay it regardless, so you might as well just call it closing costs.
Closing costs.
The one thing that is important is your lender tells you how much the closing costs are, but you're not paying your lender. It's not lender fees.
Yes.
The lender does have fees, but the closing costs are not all lender fees.
Correct.
your
So I wanna
attorney,
separate into
insurance, taxes.
separate brackets.
Exactly. It's all these. It's basically third-party fees that we have to pay when we buy a
Correct.
house, and the lender is just basically the messenger.
Correct.
They tell you how much
Okay.
it's going to cost.
Okay, I think we explained the question. Like I
Yeah.
hope we covered that part. What are the things we can talk about? What would be a good question?
Costs of buying a house. When we talked about, we really talked about all the upfront costs. Here's one: is due diligence and earnest money.
Okay.
So, how much can someone expect to pay for those?
Oh, that's a long story too. I think it all depends on the market. That's something you can. Due diligence is the money which, just explain very quickly what it is. Due diligence is the money you pay to the seller to basically take the house off the market, so you can do, during that time, you can do your due diligence, your inspections, your appraisals, and negotiate if there is anything to be negotiated at that point. So that's the due diligence. And then this money goes to the attorney and it's kept in an escrow. Both of this money become part of your buy of the sale of the house, price of the house if we go to closing. If you don't go to closing, the due diligence will stay with the seller, and earnest money, if it's during the after due diligence time, will be returned to the buyer. And this is something, it's a negotiation tool, I would say. How much you wanna pay depends on the market. I would totally depends on the market. If there is a normal market, house is on a sale, staying on the market, I would say normally you would expect anything between $2,000 to $5,000, depends on the price of the house, of course. But if you really wanna win that offer, that due diligence is gonna be very important. How much actually you're willing to put online and give it to seller. Basically, you're giving this to seller to take this house off the market, but that way you're also showing the commitment to buy the house itself. And I have seen it anything from $500 to actually $40,000, which scares me at this point.
Yeah.
At this point, it's scary. Yes,
Yeah.
that'd be scary, but buyers could do that too. And I would never advise that. They wanted to do it, I let them do it, but I would, that's something you have to think about. That if there's something wrong with the house, you're not getting this money back by law. Sometimes you can fight for it, but it's very rarely that you're gonna get the earnest money back. So at this point, the earnest money is not as important as the due diligence. So that money upfront to the seller are very important. I would say like in normal market, you can expect anything from 1,000 to 5,000. Depends on the price. But that's something like say you're paying up front, but that becomes part of the price and the price of the house basically. So you're getting this back if everything goes well.
And earnest money is pretty universal in all different states. What were you gonna say? Due diligence.
It's not.
It's more or less really just a North Carolina thing, right?
There are other states which have it, I know, but not many states have that. That's true. Honest money, it's everywhere.
Yeah.
That's what it is. But due diligence, and when I asked, kind of dig a little more into it, and I asked actually real estate commission why we have that. It was more to protect the seller actually, because there's never protection to the seller. And you have to think about when seller took the house off the market, and buyer took his time for inspections and everything, and decided to walk away. That really put the seller in a position that, I would say the old listings like stale bread, nobody wants to touch it. And that's basically what it is. Even still now, which blows my mind, we don't have enough. We don't have enough houses, but people, that house been on the market for 50 days. That doesn't mean there's something wrong with the house, but it could be that it's back on the market due somebody didn't get the loan, or somebody inspections didn't come to agreement. So that was just to protect the seller. It kind of makes sense, but I think lately it's just that kind of a power struggle, because it just became so crazy. People started paying way too much money for due diligence, to be honest, and just gave it too much level to the seller, way too much level to the seller. But it's coming down. This market, I don't see as much of the high due diligence like it used to be 2 years ago, last year even.
I saw some crazy ones.
You did. You see this all the time. So what was your craziest one? What was your
$50,000.
Yeah, mine was 4 years. I
Due diligence.
Due diligence, and
That's
that's
crazy.
it is crazy. I
Yeah.
think it's just way too much money. I would never advise my buyer to do
No.
that. But if they decide to do it, I said, okay, I'm kind of washing my heads out on that one because it scares me. It really scares
Likewise,
me.
yeah.
Because you're giving all the negotiation. You left with nothing basically
Yeah.
as part of the negotiation.
You can't walk away.
You can walk away. You're buying because of this, and I mean to my point buyer who got like 40,000. I said, no matter what is happening to the house, we buy the house and then we're gonna worry about it.
Yeah,
It's like at
for
this
sure.
point, this is like we're gonna figure out what's wrong with this house because it just we just gave up all the negotiation. Like
Yeah.
literally like anything, any power we had to do anything with it.
You're right.
So.
So South Carolina, we're in Charlotte, and South Carolina borders Charlotte. A lot of people work in Charlotte, live in South Carolina. Does South Carolina have anything like that?
No.
Okay, so it's
South
really
Carolina
just
is
North
very
Carolina.
It's just North Carolina. So there are totally different paperwork, a little different process of buying there. No due diligence, but there are repairs coming in place, and basically seller has to repair anything what is wrong with the house. So it's very different than here, and that's important too. To especially if you live on the border, to have somebody who has both licenses.
Yeah,
So,
that's huge.
and they can understand the process of both states.
Yeah.
Yeah.
Well, that's wonderful. I mean, I think we talked about most things about how much money we have to pay up front. It's always good to have reserve money for
Yes.
repairs. Even if things aren't broken now, it's good to have them.
Correct.
Just reserves down the line.
One thing I want to ask you, because a lot of people, especially now when the rates go up, people shop the rates and they will shop different lenders.
Yeah.
What they should look for in different, because sometimes I don't know if anybody, this is the problem. I think less and less people actually sitting down with lender and talk, especially first-time home buyers. I know that they not necessarily understand this is option A, B, C, and this is how it works for you. Not everybody does this, and it scares people because they don't know what they're signing.
Sure.
So when they say I'm gonna shop, what they should be looking for with different when they're comparing the offers from different lenders.
It depends.
Okay.
And
Of course.
here is a mistake that a first-time home buyer can make. Is they just go to the cheapest lender.
What does that mean, cheapest lender?
The cheapest interest rate.
Okay.
Yeah.
Right.
And here's why.
Why?
It depends on that specific person's situation. Getting a mortgage is not easy. And you may work with a loan officer in a bank that makes it seem easy, but remember, we talked there's 25 plus people who are touching a loan. There's a lot of things happening on the back end. And I'll give you a funny, well, it's not funny at all, it's actually kind of a nightmare story, is that person who I had mentioned, who made that $50,000 due diligence, he was buying a $500,000 house, so it's 10% due diligence, and he was not my client.
Okay.
He was a different bank's client. He was a commissioned car salesman.
Okay.
And the loan officer in the bank, they pre-approved this person, gave him a great mortgage program, and then they declined his loan a week before closing.
That's a nightmare.
Nightmare.
We have 50,000 online, and this is what scares me.
Yeah.
This is so important to work with somebody who with the lender.
Yeah.
I only work with the lender who give me pre-approval letters. I know they're gonna get me to closing.
Yes.
I need like 3-4 times when I put it. I tell my lenders like I'm putting that much online. We will be closing, right? Like
Yes.
check everything. Yes, and that's a good team. That's what's important right here. What you're saying.
Yeah.
Awesome.
We did save the day.
Oh God.
We had a
yes.
special program. We were able to qualify him. He bought
Okay.
the house. But that other lender had a really great rate and could not perform. And a lender's inability to perform will cost a home buyer thousands of dollars.
Yes, it will.
In this person's case, almost $50,000.
And on the top of it, most likely we have appraisal already on the top. We have inspections already
All
performing.
done.
This is all outside, so we're adding on the top of it.
And you're probably out of your earnest money
Yes, at this
period
time.
also.
Right.
Right? So yes, you want comparable rates, right? But you also want a lender who you can trust.
Correct. 100%.
You pay for what you get. And if you go into it thinking, I just want the cheapest rate, go on Google, type in cheap mortgage rates. You're going to find someone who's going to give you a cheap mortgage. But that doesn't mean they're actually going to give you the mortgage, right? Doesn't mean you could, if you do something like that, it could result in you losing your due diligence, losing your earnest money, and losing a house that you thought you were going to buy. So yes, you want comparable rates, you want fair rates, but you also want to work with a lender who you know is going to get the job done.
Why those rates are different from, like, I always wonder that, like, I have my own things.
Yeah.
Like, why the rates are different from one bank to another? I understand that it's like standard you have to go. Why is it different?
Sure, great question. So most of the time, they're pretty close.
Right, they should be close.
They should be
We
close.
should not have 6.3 and 7.
Correct.
That's too much of a disparity. Like,
Correct.
that freaks me out.
It shouldn't be like that.
Okay.
All banks use the same, what's called par rates.
Right.
So if you're getting banks give mortgages, but most banks don't actually keep the mortgage. Mortgages are held by usually a government entity. It's called Fannie Mae if you're getting a conventional loan, and it's HUD if you're getting an FHA loan.
Mm-hmm.
So basically, the mortgage company gives the home buyer,
Mm-hmm.
you know, $300,000-$400,000. That's your mortgage,
Right.
and then one of these government entities takes the mortgage from the bank
Correct.
and gives them their money back. That way, the banks aren't just giving all this money away and not having anything in return.
Correct.
Right? They'll make money on the interest, but that takes a long time.
Okay.
Right? So the government entities are actually the ones who set the interest rates.
Correct.
Right? So Fannie Mae has par rates,
Right.
and then the banks, you know, these are for-profit organizations. They're going to say, okay, here's the par rate, here's the standard rate that we have to charge, and I'm going to get some profit on top of it. I'm going to put some more interest on top of it.
I see.
And
That depends what's that percentage.
typically, sometimes, right, the higher the rate means maybe the more expenses that the bank has, right? They want to cover their expenses, right? So expenses may mean more resources and tools to help fund the loan,
Mm-hmm.
whereas if it's a super cheap interest rate, that means maybe it's an internet lender and they have no overhead and it's just some guy with a website who's offering these cheap mortgage rates, but he doesn't have expenses because he's just some guy with a website, right? Versus, you know, if you go, typically it's like, you know, the larger organizations and institutions, they may have higher interest rates sometimes because they have more overhead, more costs.
I see.
However, you shouldn't just accept a really high interest rate. Definitely do your research and find something comparable, but you have to just make sure that it's with a company that you trust.
Correct. That is 100% correct. Important.
Yeah.
Like, so important. But that brings me to another question actually. What's the difference between when people want to go, let's say, to a bank, Wells Fargo, Bank of America, not anymore, you know, just regular bank branch and get the mortgage versus a lender? Like, what is the difference here? Like, what is the, because I got that question a few times also.
Sure.
Like, can you tell us the difference? Is there a difference or there is no difference?
Great question. So those banks that you mentioned are lenders.
Right.
There are depository institutions where they have checking, savings accounts, and they do mortgages. And there are some companies that are just mortgage banks.
Correct.
Right? Like Movement Mortgage is a mortgage bank. That's what they do.
Right.
Right?
So what is the difference between?
You know, the difference in terms of rates,
For the
maybe very little.
Okay.
Maybe very little. And that's, you know, they're always going to have their pros and cons. Each one of them, maybe they specialize in one thing. Some banks will say, hey, I'm going to charge a little bit more for these programs, but I'm going to really discount my rates for these programs because I really like to do these things and I'm really good at these specific programs.
Okay.
They may do that. But from a consumer point of view, I wouldn't say that there's any big difference in rates. They should be relatively comparable.
Okay.
And this is where it becomes just very important who the loan officer that you work with is. Because you can have two loan officers, two mortgage advisors who work for the same company, but give you a very different experience.
For sure.
right? Mortgages have guidelines, and there's all these different types of mortgages. We talked about conventional, FHA, VA, USDA, down payment assistance programs, and each one of them have their own rule books. And these rule books are like 2,000 pages each, and they're just textbooks, right? So a good loan officer is going to know the rules. They study a lot. But if you're new, think of it like this. If there's 4 or 5 different rule books and they're all 2,000 pages each, and you're new, you probably are not going to know what you're doing for a little bit of time. You need experience. And so that's why I think it's maybe more important to choose your loan officer versus the mortgage company. Just like with a realtor, right? You can have 2 realtors, one of them has been in the industry for 10, 20 years, the other one, they're part-time.
But we can't this very difference, because people ask me, I said, oh, somebody does this for 10 years. Yes, but it's not the years you are in a business, it's the transactions you do.
Exactly.
This is very different.
100%, yes.
This is, people are confused, yeah, but she's told we've done this for 10 years. I said, how many transactions did we actually have?
And part-time, the whole time.
And part-time, and this is a huge difference.
You're totally right.
If you do this like once in a blue moon, or this is your bread and butter kind of.
How many people have you had?
Like, actually, I'm surprised, because actually the clients were surprised, oh, you do this all the time? Like, I'm like, that's my job.
Yeah.
Like, this is not, I'm not doing this to buy a new purse.
It's not a hobby.
I feed the family with it. So
Yes.
I do this every single day. That's why we step on the top of the market all the time. And market changes quickly. So that's another thing. Interesting what you said there, that it's not the institution itself, but it's the person,
It's
the
the
loan
person.
of, and absolutely right. It goes the same way, I would say, with the real estate agent. It's not necessarily which company. It's more important for me which company I am associated, but not from the consumer point.
Exactly.
That would not make a difference.
They
at
get
all.
you.
They just get me, and it doesn't matter if I'm like used to do it Remax or Holder or whatever.
Yeah.
I might go. It's you just get me and all the tools I have behind it, and create my wisdom, my knowledge, and my experience most of all in real estate. That is awesome. I like this conversation.
Yeah.
I like this.
Yeah, and honestly, I mean, I think that might be a great way to wrap it up.
I think it might be.
Right? And moral of the story is, we talk about how much it costs, but choose your team wisely. A buyer isn't paying for their realtor service most of the time. A buyer is not paying for their lender service most of the time.
Mm-hmm.
So choose the best team that you can get.
And this is another thing. You have to understand that you're getting a team. Experienced realtor, experienced mortgage will have the team of people behind it. If something happens, we're making sure that there is no bumps on the road. If there is, the buyer will not know. We covered it all by ourselves.
Story of my life.
Make it a smooth transaction. What's
Yeah.
happened behind the door, it stays behind
Yes.
the great team.
Yeah.
And to make sure that we create the best smooth transaction for a buyer or the seller, the buyer mostly at this point
Yeah.
we're talking. So yeah.
Evona, Cholewa, everybody. Evona,
Thank you so much.
Thank you so
for this.
much.
I appreciate that. That was awesome of you to do this again.
Absolutely. Thank you.